Very good. Ladies and gentlemen, a very warm welcome to the National Press Club and to the Geneva Association's conference on the addressing the challenge of global aging. You're all very welcome, and a big welcome also to those who have joined us on the webcast. My name is Anthony Kenaway. I'm the head of communications for the Geneva Association. Let me just quickly talk you through our agenda. Just a welcome from Dr. von Bomhard, the chairman of the Geneva Association, also chairman of the Board of Management of Munich Re. An introduction from John Strangfeld, who's the vice chairman of the Geneva Association and president and CEO of Prudential Financial. Dr. Richard Jackson will then talk to us about the phenomenon of global aging, and then finally the Secretary General and Managing Director of the Geneva Association, Patrick Liedtke, will talk us through some of the insurance solutions, and we will then move to some Q&As. Just a couple of housekeeping points, if I may, beforehand. The slides and speaker biographies are downloadable on the webcast for those of you who are watching online. There are also selected graphs and statistics available on the dedicated website we've created, www.globalagingchallenge.com. It's actually the European and UK spelling of aging there, so it's A-G-E-I-N-G. The webcast has a facility to ask questions, and if you'd like to ask any questions online, please put your name and your organisation before your question, and then they will be brought into the room. Anybody in the room, please just wait for a microphone. And finally, if I could ask you to please switch off any mobile phones that are on in the room. They'll interfere with the webcast and also with the delivery of the presentation. And I'll now hand over to Dr. Nikolaus von Bomhard, who's the chairman of the Geneva Association. Thank you.
Well, good morning, ladies and gentlemen, and thank you, Anthony, for your kind introduction. A welcome to all of you to the press briefing, to the opening event of the 39th General Assembly of the Geneva Association. First of all, I would like to thank our US hosts for preparing us and preparing the entire General Assembly. AIG, the Hartford, Liberty Mutual, MetLife, Prudential Financial, New York Life, and the Reinsurance Group of America. First of all, of course, we are honored to have John Strangfeld, Chairman and Chief Executive Officer of the Prudential Financial, here with us, Vice Chairman also of the Geneva Association, who will be taking part in the press conference, and also Greg Woodring is among us, here of the Reinsurance Group of America, in the third row. Welcome to you both. And before delving into the issue of global aging, I first wanted to talk about, briefly, the research projects that have brought us to this point and how it fits under the remit of the association. For those of you who have not yet come across the Geneva Association, it is the leading research and global advocacy think tank for the insurance industry, and it is focused on tackling the truly relevant strategic challenges that face insurance. It focuses on specific issues using research-based commentary to address both the industry itself and its outside stakeholders on the role of insurance in addressing these challenges. Its membership is made up of chief executives of some of the world's largest insurers. The statutes of the association limit that number to a maximum of 90. The key issues of focus at the moment have been financial stability, of course, where we have been undertaking research and analysis to position the insurance industry in the wider debates that have been underway at the G20 and the FSB, and certainly at insurance regulators, and this is mostly about systemic risk. Another issue of focus of ours is climate change, where we have been a regular attendee at the UNFCCC annual meetings and elaborating on the role that insurance can play in adapting to climate change, but also mitigating the consequences of it. And, of course, the third one of what we are here today to hear and talk about, global aging. Global aging is a phenomenon that the association has been working on for a considerable time. It is covered in separate ways by both the Health and the Aging Research Program and the 4-pillar program at the association. The Health and the Aging Program bring together analysis, studies, and research linked to issues in health provision and the role of insurance, with an emphasis on the changing demographic structure of society. The 4 Pillars program, this year celebrating its 25th year, began as a project to advocate a 4th pillar of the pensions system. In addition to state social security, stakeholder or employment pensions and private savings, known as Pillars 1, 2, and 3 in Europe, it argues that members of older generations make a valid economic and social contribution to the functioning of our service economies through a flexible extension of their working life, mainly on a part-time basis, in order to supplement income from the 3 existing pillars for future years. This would involve the continued support of workers over retirement age by governments as well as employers, enabling them to continue to earn longer into their lives, to provide the value of their experience on an ongoing basis to the company or organization for which they work. That role of advocating this 4th pillar has expanded to study and understand the challenges modern societies face with their old age provision systems. That is to advocate also the consolidation of the sources of pension financing by encouraging complementary development of the 2nd and 3rd pillars, and more generally, modernization of social security through greater integration of private insurance, and not giving up, of course, to promote the idea of what I called the 4th pillar. The 4th pillar to supplement the resources from the first 3 pillars of pension financing, that is, of income from part-time work after reaching retirement age. Of course, the issue of aging is becoming increasingly urgent, and that is why we will be talking about it today here with you. Our living longer is putting a great strain on both public and private finances. When the benchmark state pension scheme was developed in 1889 by Otto von Bismarck, the system was designed to support, and I quote here, those who are disabled from work by age and invalidity. Quote ends. Bismarck's chosen threshold of 65 years was almost 30 years higher than the average male or female life expectancy at birth in Germany around 1880. For the men, it was 35.6 years, and for the women, it was 38.4. Unbelievable today. Extrapolating those states out to today would mean that the modern retirement age, for example, the UK and much of Western Europe, should be well above 90 years. Even if we only had tried to keep the average duration of pension payments constant over the past 4 decades, the retirement age today would be well into the 70s, according to research of the Geneva Association. Well, so much for challenges. We are here to talk about solutions. And I have no doubt in my mind that the insurance industry as such, can make and does make very significant contribution to tackle the economic challenges of aging population. I would like to thank you all for joining us here today. And again, I thank our hosts for preparing everything. And with that, I would like to hand it over to John and Greg, in case we ask you some questions too, having a wonderful oversight of the reinsurance life industry here in the United States. But John, you're up. Thank you.
Thank you, Nikolaus. Thank you very much. I'd like to thank all those of you who are here today in person in Washington and those of you who are watching by the website for joining us in today's event to launch Geneva's important new report on the challenge of aging population and what it means around the world. And this report focuses in particular on funding issues aging poses for the public and private sector retirement plans and the role that insurance solutions can play in the global issue of retirement security. Now, as Nikolaus mentioned, aging is one of the most significant social issues facing societies around the world, both in developing markets and in emerging markets. Populations are aging because of people living longer and birth rates decline. While the demographic shift is not new, it is of heightened recognition, particularly in light of some of the financial challenges that other parts of our world and society bring to pace. And so we've got policymakers, regulators, and companies increasingly focused on this issue. And thus, this report could not be more timely. Government, corporations, and individuals around the world are already feeling the strain of aging populations. Pension systems are grappling with the impact of increased longevity on pension liabilities. They're facing rising costs. Both governments and employers are increasingly seeking to shift the burden to the individuals and have them in turn supported through increased savings and, as Nikolaus mentioned, living or working longer as well. I hadn't heard about the 90-plus example, but that's rather frightening, yes. Coupled with that, we have a challenging economy, we have low interest rates and inadequate retirement savings rates in many parts of the world, which means that the risk that current or future generations will not be able to achieve a secure retirement is growing. So while this report focuses on some of those challenges, it also outlines the steps that can be taken by governments, employers, and individuals to address these challenges. Raising the retirement age for government-sponsored pension plans may be unpopular, but may have a significant impact on funding levels. Pension risk transfer techniques, widely used in Europe and increasingly adopted in the U.S., can significantly reduce pension risks for companies while helping them fulfill their obligations to retirees. The new generation of insurance-based retirement products, including guaranteed lifetime income annuities, can help individuals manage that financial challenge of increased longevity as well. The insurance industry, with its long-term perspective, institutional investment, and actuarial expertise, as well as its financial strength, is well positioned to have an important role in the solution of meeting the financial needs of an aging population. And addressing the impact of an aging population will require a comprehensive, broad-based response from both the public and the private sectors. And this report serves as a valuable starting point for what will need to be an ongoing dialogue about the challenges and how to address them. I'm the tee up. That's the tee up. So what I'd like to do now is introduce Richard Jackson, Director and Senior Fellow of the Global Aging Initiative for the Center of Strategic and International Studies, who will discuss the challenges facing governments today. Thank you very much. Richard.
Thank you. Thank you and good morning. The world stands on the threshold of a stunning demographic transformation. It's called global aging, and it's brought about by declining birth rates and by rising life expectancy. For most of human history, the elderly comprised only a tiny fraction of the population, never more than 3 or 4% of the total until well into the Industrial Revolution of the 19th century. In today's developed world, the elderly make up roughly 15% of the population. That share is headed for roughly 25% by the middle of the century, and that's just the average. In Japan and some of the faster aging countries of continental Europe, the elderly share of the population will be reaching or even passing 35%. Now, the rich world may be leading the way into humanity's graying future, but much of the emerging world is not far behind. And in fact, some countries are traversing the entire demographic distance from young and rapidly growing to old and stagnant or declining at a breathtaking pace. By the 2030s, Mexico will be nearly as old as the United States, and China will be older. Meanwhile, South Korea will be vying with Italy, Germany, and Japan for the title of oldest country on Earth. For the rich world, where most countries have large, expensive, and mature pay-as-you-go old age benefit programs, the most obvious and certain challenge is the fiscal challenge. Graying means paying more for pensions, more for health care, more for long-term care for the frail elderly. On average, across the developed world, in order to maintain the current generosity of old age benefit systems, we're looking at an extra 8, 10, 12% of GDP between now and 2050. Very few countries have the fiscal room to raise taxes to pay for more than a fraction of the increase in old age benefit spending. Most will have to cut benefits. And indeed, some already have large prospective benefit cuts in the pipeline. France has re-indexed the second tier of its pension system from wages to prices. Sweden and Italy are transforming their traditional defined benefit state pension systems into less generous notional defined contribution systems. Japan and Germany have partially or fully indexed their state pension systems themselves to changing demographics, so that as the ratio of contributing workers to retired beneficiaries declines, benefit levels are adjusted automatically. The problem is that the elderly in most developed countries are highly dependent on public benefits, and that the aged will be a growing share of the electorate. In fact, in Japan and many European countries, more than half of the electorate will be aged 50 or older by the 2030s. So there's likely to be growing political resistance to reform. And so what do politicians do when faced with the choice between an economically ruinous tax hike and a politically suicidal benefit cut? Well, you've got two other choices. You can cannibalize the rest of government spending, right, and crowd that out in favor of old age benefits, or you can run widening fiscal deficits, undermining national savings and economic growth. And in fact, certainly in the United States, we're seeing some of both of those. Beyond the fiscal challenge, there's also an economic growth challenge. Beyond and totally apart from, even if we solved the fiscal problem, there's an economic growth challenge. By the 2020s, the working age population in Japan and many European countries will be contracting by between 0.5 and 1.5% per year. Unless productivity rises at least as fast as employment falls, we may see a stagnation in aggregate GDP, or even a contraction in aggregate GDP. This is not a cyclical phenomenon, this is a secular phenomenon. Economists define a recession as 2 consecutive quarters of negative GDP growth. They have no word for an economy that shrinks from peak to peak or trough to trough of the business cycle. Now, if productivity were to surge, it could offset the contraction in employment. But in fact, the aging of the population is more likely to pull productivity down as rates of savings and investment fall, and as the average age of the workforce rises. The economic challenge itself may lead to a shift in business climate and in social mood. Stagnant or contracting domestic economies and aging workforces are likely to increase adjustment costs in both product and labor markets. We may see growing protectionist pressure. I mean, historically, contracting markets have gone hand in hand with beggar thy neighbor protectionism. Just think of the 1930s. The shift in business climate may itself be mirrored by a broader shift in social mood. We know how individual behavior and risk preference changes across the individual life cycle. We may know some 20-year-olds who are extremely risk-averse and some 80-year-olds who are risk-taking entrepreneurs, but there's a typical pattern of shrinking time horizons and growing risk aversion. The question is, will this occur at the overall societal level, and what are the implications for political leadership and electoral behavior? Will aging electorates prefer current consumption over investment in the future, or will they make room for opportunity for the young? Now, I should say just a word about where the U.S. stands in all of this. And it may come as a surprise to some of you that, in fact, the United States enjoys a relatively advantaged position. Yes, the United States is aging. As the baby boom crosses the threshold of old age, the elderly share of the population will ramp up dramatically. Associated with that, there'll be a big fiscal shock and a big labor market shock. But in fact, the United States is the youngest of the developed countries today, and thanks to its relatively high fertility rate and to substantial net immigration, which all of the controversy and hand-wringing aside, we do a better job of assimilating than most other countries. We will still be the youngest, and by an even wider margin, in 2030, 2040, or 2050. We also have broad and deep capital markets. What did I do? Broad and deep capital markets, perhaps not as broad and deep as they were a few years ago, but still. Flexible labor markets, and entrepreneurial culture. But we suffer under several large and largely self-inflicted handicaps. We have the lowest savings rate of any major developed country. We have an extraordinarily expensive healthcare system. We spend at least 50% more per capita than the next runner-up. And we have a political culture which seems incapable of making adult resource trade-offs between competing priorities. So at the end of the day, perhaps we end up not much better off than a much more rapidly aging Italy or Japan. I should probably draw this rapidly to a conclusion. I had wanted to say something about the emerging world. I will simply say that the challenge there is somewhat different. Many countries are growing old before they grow affluent, and more crucially, before they've had time to put in place the full social protections of a modern welfare state. So if the challenge in the rich world is how to afford generous promises that were made back when the population was much younger and the workforce was rapidly growing, the challenge in the emerging world is how to minimize the growing vulnerability of the old, a majority of whom in many countries will not have pensions, will not have health care, depend on the family, but the family's under pressure and is shrinking in size. Strategic responses. For the rich world, reduce the pay-as-you-go benefit burden. On the pension side, there are many ways to do this. Systems in one way or another need to be indexed to the changing demographics. On the healthcare side, you need a global budget on spending. The only real question is how that budget is enforced, by government or markets. At the same time, reducing fiscal costs is not a lasting solution unless reforms also ensure adequate income for the old. Poverty floors need to be strengthened, and the income of middle-income elders needs to be shored up by expanding funded retirement savings, whether through pension or insurance mechanisms. And at the same time, and I'll end on this point because I've clearly run out of time, we need to maximize society's human capital. And above all, in aging societies, and above all, this means increasing retirement ages. It's good for public budgets, it's good for the economy, and according to most gerontologists, it's good for the elderly themselves. Thank you.
Thank you very much, Chairman, Vice Chairman. Thank you for being here. It's a great pleasure to be in Washington and introduce the Geneva Association report. It's one of the massive challenges that we face, not only in the US, but around the globe in different ways. And it has been a great pleasure to work with so many fine individuals. Richard Jackson was one of the authors. We've got others in the room, like Christine Marks, Margaret MacDonald, or my colleague Christopher Staszewski, who runs our Four Pillars research program. And thanks go also to my co-editor, Kai-Uwe Schanz, who stayed back in Europe to try to make sure that they solve the problem over there while we're solving it over here. The changes in global aging, allow me one sentence, because this is the basic conviction why we believe, and I think we share that with Mr. Jackson here, that we can solve it. There's a confluence of, on the one hand, systemic inflexibility that we have ourselves created and an unparalleled historic experience. On the one hand side, we have a very, very dynamic development of life expectancy, and especially over the past decades of remaining life expectancy of especially the elder people, which is great news. We all wanted that. It's fantastic. At the same time, we have a massive drop in fertility rates around the world. As we've just learned, in the US, of course, it is much less pronounced than in other countries, but it's also declining in the US. And what is of interest here, for those who are actuaries, it's not the absolute level of fertility that's the real kicker. It is the dynamic development of fertility going down that is applying most of the pressure on our pension systems, and we have to somehow stop this. And that's one of the solutions that we actually have in the report. Now, these two issues are meeting something that is relatively new. New because we have created it only about 120 years ago, and the name of Bismarck was mentioned. And when Bismarck introduced his system, he basically did so by introducing a fairly rigid retirement age, not thinking that people could ever reach the venerable ages of 100 or 110, which happens more around the world every day. But he also did something else. His preoccupation, and the preoccupation of the Germans at the time, was that they were saying, well, we want to protect people from a position that they're not able to be so productive that they can live for themselves based on the work and the labor that they are performing themselves. And then they introduced age as a proxy for productivity, which of course we all know is not true. Because look around you, people at the age of 60 and 65, when they think about retirement, they're immensely productive, immensely active. And we are basically telling them that, well, we don't want you anymore in the labor market. And that is a waste of economic and financial resource that shouldn't go on. And this is now coupled in recent years, exacerbating the problem, because we have a risk shift from public to private, whereby governments and employers are reducing their commitments, and individuals need to assume more of their own risks, which is placing them in more difficult positions in order to be able to cope with a new development that they have very little experience, and time horizons where we know from behavioral economics that making decisions on these time horizons is extremely complicated, complex, and we're not very well suited to that. And then over the past few years, we've had the financial crisis, not only leading to a destruction of assets on unprecedented scale, but also, what is more important, to a loss of confidence and trust in the system. How can we expect people to actually trust the system if they've gone through a series of learnings over the past years that are telling them, well, you know, there are limits to that trust. And maybe, you come to a different conclusion as an individual, how far you want to have governments actually exercising control over your future pension rights if you know that they're under the pressure that Dr. Jackson actually explained. Now, we believe that insurance is a unique position to actually help. It is not the panacea, but it has expertise in underwriting, it knows about risk pricing, can manage longevity risks better than many other sectors. It has comprehensive solutions to address risks and to contribute to old age security, and skills and experience to design innovative products, and we will need that. At the same time, we will have to get more people to cooperate. It is not just a question of insurance coming in and being the white knight. It is a question of governments, employers, individuals, and insurers collaborating, making sure that we find comprehensive solutions that will stand the test of time and that will do away with the systemic rigidities that we have created ourselves. Our report looks at these points. Now, there are a series of recommendations from governments. We've already heard some, but two of them, I believe, are very important here, and those are the middle ones. Eliminate incentives for early retirement. We shouldn't get rid of people who are interested and capable to work and make a positive, productive contribution in our system. We need to keep them engaged for longer. Why is it good to integrate more young people and supposedly bad to keep the elderly integrated for longer? We need to change. The second point is we need to provide conducive institutional frameworks for an increased private sector participation. If governments and employers are less willing to shoulder risks and individuals are in greater need to do so, they need partners. Insurers can be partners, but they need to have the right framework in order to be partners that can actually deploy expertise and help people do that. We also believe that there is a lot to do when it comes to part-time work beyond the official retirement age. It is, of course, little attractive to offer to a 70 or 75-year-old, or as Dr. von Bomhard explained, to a 95-year-old, the same workplace and same arrangement as a 25 or 35-year-old. But if you tell them that they can work in a way that is more aligned with their personal preferences and more aligned with where they find themselves in their personal life cycle, then probably the take-up and the reaction of individuals towards these proposals is going to be much better than what we are seeing now. People are bowing out of the labor market because they think that at the age of 65, they do not want to do the same thing for another 20 years that they've been doing for over 40 years. But if we propose to them something different, then the answer might be different and we could keep them up. To react to that, we need employers to be in the boat. Employers who are reviewing their own risk-bearing capacity, who can help their employees shoulder these risks, who can be partners, who can make retirement and pension issues a cornerstone of employee communication, and who can capture themselves the potential of what we call the silver workers, those above the age of what we today define as the retirement age. Provide them with opportunities, and we will have a more stable system that actually pays for itself, at least for a certain amount of our retirees who could be active part-time. When it comes to individuals, we of course also need an approach where they accept more. They need to accept more responsibility for planning ahead. They need to accept the need to pursue a multi-pillared approach. They need to accept the need to save more. They need to accept the need to work longer. And they need to take action. And this is where insurers can actually help. Insurers are good when it comes to looking at biometric risks. They're experts. They can support these developments. They can be innovative. They can optimize product prices and design, rethink business models, and educate the public on the cost of longevity. And this is where we believe we can help. A final thought. Financing old age is a problem primarily due to inherent design flaws and an inability to reform existing systems comprehensively. We need to make use of a variety of instruments to create sustainable solutions. Long existing reform fears and stagnation will need to be overcome. And we ought to overcome them sooner rather than later, because we know that this is a slow-moving problem that needs solutions now. Unfortunately, the problem is exacerbated by the limited connection between also some aspects of current technical reform projects and the overarching aim to secure proper old age security. What do I mean by that? We are reforming systems. We are trying to make them safer. We are trying to increase the resilience. We are trying to become more efficient, but very often we do so on a technical level. And we need to ask ourselves the question more, why are we doing this? Why is financial stability so important? Well, one part of the answer is it is so important because people need to be able to plan and have confidence that what they plan and set up today will be there when they need it tomorrow and the day after. And we need to create that. And some regulatory initiatives that we have harbor some elements that from a technical point of view look all very plausible. But they might actually be working against the larger aim. There are reform projects like solvency and risk-based capital reforms that are not going in the right direction, not in all their elements in any ways. There are accounting and financial reporting reforms that contain some elements that will make it more difficult for people to provide long-term, stable solutions. We're looking at increasing the resilience of our financial systems, and we are doing so deploying also some elements that will make it more difficult for people to be there to help individuals shoulder the risks. What happens if we price insurers and other pension and old age security providers out of the market? It will not help. And the same for fiscal and tax reforms where we need that. I think we need to find a better balance, and part of that balance actually is in our report. Thank you for your attention.
Patrick, thank you very much indeed. Ladies and gentlemen, a veritable feast of food for thought there. And I'd like now like to open the floor for questions. If you would like to ask a question, please put your hand up. We will also be taking questions from the webcast as well. But we'd like to now open the floor to questions. Thank you.
Hi, Reshma Kapadia at Smart Money Magazine. Can you address how the insurance industry is perhaps changing or tweaking its assumptions given sort of the economic situation that some of you have outlined in terms of economic growth and obviously the higher unemployment, possible inflation and taxes that we may face over the next sort of 20 to 30 years? I mean, has there been a reduction in return expectations or whatnot for sort of this group that you've put out there?
Let me look at the panel. John, was that something you think you'd be able to handle?
Well, I think it's fair to say there's lots of factors that go into the pricing and thinking about products. And part of it is the actuarial phenomena of longevity and longer lives and so forth. And another aspect of this is the investment environment. Because keep in mind, what we're basically doing is taking a situation in many of our products where we're substituting what used to happen with our parents' generation or our grandparents' generation, where they would get the equivalent of a pension check in their mailbox, where they would have a predictable experience for the remainder of their life. And frankly, in the case of many middle Americans, this is what they would still prefer to have today. Because of the transition from DB to DC plans, increasingly Americans have recognized they're not that well suited to manufacturing it themselves. It's hard for an individual to know their own longevity on an individual single data point basis, whereas the law of large numbers we can work with. The other piece that's difficult for an individual is the investment outlook, asset allocation, time horizons, et cetera. The longevity piece has some predictable aspects to it. The investment climates have some variability to it, and it's reasonable to assume that as we try to work this, on the one hand, we're able to think long-term, much more long-term than most institutions, because these liabilities tend to be long-term. On the other hand, we have to keep mindful of the current environment, whether it's as it relates to interest rates or whether as it relates to equity markets and the like. So those factors do indeed have to enter into that mix as we're thinking about the products and how we make them available. But the long-term forces are undeniably strong, and I think our feeling is that this is a terrific place to be for our industry to be in, where historically our clients, going back a generation or two, were more concerned about their mortality and their premature demise and leaving their family with unfulfilled, with an inability to maintain their quality of life. And while those forces remain important, increasingly because of this aging population, people are much more concerned about outliving their resources and becoming a burden. And this is a way that we can have a very meaningful role in maintaining that quality of life in a longer stretch of time. So those economic variables move, the longevity factors have long-term secular forces to them, but those are all forces that are frankly much better for an insurance institution who's accustomed to the actuarial circumstances and the investment circumstances, much better suited to do it than the individual is. And so to us, it's a wonderful intersection between social needs and commercial opportunities and the role that we play.
Thank you.
Hi, this is Dave Dudley from AARP, the magazine. Dr. Jackson, you mentioned that the political culture here in the States is perhaps exacerbating our inability to deal with sort of the trade-offs that states need to make in terms of reforming their systems. Can you give any examples of countries around the world that are more successful, that have more of a what you would say is a correct long-term solution to rebalancing their pension needs and so forth?
Certainly, I'd be happy to give at least a number of examples of countries that are attempting to grapple with the challenge. As I mentioned, a number of countries have made very substantial long-term reductions in the cost of their pay-as-you-go pension systems. I would cite Sweden and Germany in particular as positive examples, because not only are they reducing the pay-as-you-go burden, but they're also filling in the resulting income gap with new funded pension options and also by extending work lives. Now, another example I think that's worth citing is Australia, which uniquely among the rich countries does not have a large earnings-related pay-as-you-go pension system. It has a rather generous means-tested benefit, which most people up to and beyond the median income receive. And on top of that, it has a large mandatory funded pension system. It's an employer-based system. The operative word there, well, two operative words. One is it's large enough, a contribution rate of 10 or 12% to generate a significant benefit, and it's mandatory. Voluntary systems, we know from experience, do not achieve anything close to universal coverage. Mandates do much better at that. So there are at least a range of countries that are moving constructively to address the challenge, whereas policy in the United States, unfortunately, remains gridlocked. This is not to say that there's a one-size-fits-all reform, but that compromise and progress is possible.
If I may add something here, Richard, it's interesting because you fondly and kindly mentioned Germany. I come from Germany, and we always look to the US. And first thought, well, the paradigm of thinking in the US is much more helpful because people are educated on the basis you look after your own affairs. Whereas in most of Central Europe, people say, well, this is the government's duty in the first place. I have a vested right. So they, and this is the Bismarckian idea somehow, but maybe distorted to some extent, the government must take care of that. And that, of course, for a politician in Europe is a real uphill struggle. The experience we have in Europe is if it is a more of a left-wing party, it is much easier for them to turn the corner and cut one way or the other into the system and push part of the retirement load into a funded system. The more this party is a center party, it is almost a battle they can't win, because the left will give them such a hard time. And what can a more right or central party say if a left party changes the system? So that is what we saw in Germany, that exactly was a more left party that changed the system to some extent, and it doesn't need much of a turn of a screw to really bring big relief to the system. Unfortunately, in Germany, and that is the bad news here, partly we're going already back because they undo what they did rightly at a certain time. And one should also think there's another issue in all that, and that is democracy as such is not helpful. Because if you are elected for 4 years here, why would you change a system where the benefit is for God knows whom, but certainly in your 4 years you only sell, and it was mentioned in the presentations, you sell the bad news to your electorate, and someone else later on will probably then harvest the result of it. So the democratic system makes it very, very difficult to change it. And the more older people you have, and we see that in Germany, we talk about the revolution of the Grey Panthers. They have so much of a saying in the political world today that it is for every year we wait longer, it will be even more difficult in the democratic system to change it. So in one country that you didn't mention that always comes to my mind who did it, and actually I think on the advice of Americans, was Chile. Chile is the one that did it after the change in the political system, right from the start, relatively determined. And this is, for me, that country, of course, it's small, and the size of a country makes a difference too, but they did a wonderful job there.
Yes, and I might add,
Yeah.
if I may, that it was also a Labour government in Australia that initiated the reform. So it's sort of the domestic equivalent of, you know, the old cliche in the United States about Nixon going to China. And yes, I would agree on Chile, particularly after they've added the new non-contributory floor of protection in the recent reform of the reform.
Thank you. We now got a question, I think, from the webcast, Eric.
That's great. It's working, yes. For Mr. Strangfeld, in light of Prudential's major pension risk transfer deal with GM last week, do you see these types of deals as a growing trend in the U.S.?
Yes. Couple of thoughts, observations to elaborate on the one line. I think what we're seeing here is for many American companies, and this is not unique to America, UK has been doing this for a while, but for many American companies, what's happened is pension issues are increasingly overshadowing their operating results. And the prospect for that is even intensified when you look at the funding requirements that are being placed on them, when you look upon accounting changes that are going to introduce greater volatility, and when you also recognize that these pension obligations largely have to do with retirees, not current employees. So all of those forces tend to encourage companies to take a fresh look at what to do and how to do it, and what are different ways where they can take responsible steps that are both responsible to the retirees and responsible to the corporation on a go-forward basis. And in your question about the General Motors situation is one whereby they're effectively transferring the retiree obligations to Prudential through the purchase of a group annuity contract. It's very large in scale because of the size of GM's pension plan. We think it's the shape of things to come. Let's face it, the primary risks associated with these pension plans are actuarial risks and investment risks, and those are the type of risks that are much better suited to a financial institution than they are a car company. By their own admission, and so we think that this is a really good phenomena, and we think that there will be more of this that will follow, and we think it benefits the retirees, and we think it makes sense for the plan sponsors as well.
John, thank you very much indeed. I think we'll wrap it up then. There's now a chance for a lunch next door, to which you're also very welcome. And I'd like finally just to end up with thanking the panel very much indeed for their insights and their thoughts this morning. And I'd like to thank them with a round of applause. Thank you.